And we're live. Hi, everybody. This is Zania and Masha from Value Tokenize. Thank you for watching. It's no secret that right now we're all going through really turbulent times on the markets. And especially in this kind of market, it is vital to have somewhere safe to park your assets and to have a store of value that actually does this function. And we found no better person to describe this with what is going on in the market and what you should better do with your crypto and how do you bridge and benefit from the both worlds, financial and crypto world. And this is Marc Fleury. Hi, Marc.
Hello.
Marc is the founder of 2Prime and Open Source Guru, and we're very excited to have you with us today. And probably my first question would be, how would you comment on the current situation of the market? What's going on? How do we make sense of what's going on in the market and how we understand what's going on with the crypto in this context?
What's going on in the market is a chaotic transition right now due to COVID isolation and disruption of supply chains. 2008 was a very different animal because it was mostly confined to the financial sphere as opposed to the economic real life. 2019, 2020 is very different in that respect because the causality actually starts with an economic disruption, specifically economic of supply chains and work. And we are witnessing its impact on the financial markets. The first thing to address is probably the monetary angle with inflation and deflation. You're seeing very aggressive actions by the central banks to print money at several layers of the financial system, including the repo layers to make sure the banks have the reserves they need to function. But more importantly, at the retail layer, you have stimulus in the United States, in Europe, direct helicopter money drops to the populace. The reasons for that are very simply social unrest or social peace, the opposite, meaning now that we have abundance but we don't work, do we die of starvation next to the food? I was reading this report that in the Netherlands, they're stockpiling millions of kilos of potato because nobody's eating fries.
Mm-hmm.
And we're anguished, going like, oh my God, we're producing this and we're not eating it. Well, that's the good news. We have reached abundance. The problem is the distribution of the abundance through the financial layers, which in this post-capitalist world is still stuck in the work for hire and work for pay. And if you don't work, you don't eat. Obviously, that's going to change very soon with proposals like UBI in Spain, etc. But the macro background of complete uncertainty as to the value of assets is one that is very important for the crypto heads, and I'll focus now a little bit more on the crypto. Essentially, when the money flows to a market, the assets will all go up at the same time. This is the inflation of assets, not inflation of core goods, but inflation of assets. Because on the core goods of consumption, we're seeing deflation, namely because nobody's working, because there's no money flowing, the actual amount of flow that is entering the economy is much lesser, even with the $2 trillion stimulus in the United States. It's a fraction of what people get paid normally. People are making $1,200 when they normally would be making $2,000, $3,000 a month. So the amount of money entering the economy is much lesser. But remember that inflation is the ratio of money to goods. Not just money. Money by itself does not give us inflation. It's the what new money and what new goods. Now, the goods also have been disrupted. Namely, there's no supply chain. China stopped producing for a while, though they're starting again. So that the balance of new money and new goods may, in fact, follow the deflationary scenario, which is the only historical example we actually have of a survival through a crisis like this in Japan. The deflation of the bubble in Japan, of the explosion of the 80s bubble in Japan, has led actually to a asset deflation across the board, with aging population, less work. But it's not this end of the world scenario everybody's imagining where we all die of hunger, actually Japan is a really cool place to be, as you know. It's wealthy, it's healthy, it's a very, very high quality of life, probably one of the highest on the planet. And so this whole deflation of the assets is really just a story in the financial layer, not that to minimize the pain we're all going through in the markets. I'm going through massive pain in the markets. But at the end of the day, when you're talking about real goods, Maslow 1 and 2, food and shelter, in fact, we may have the abundance. The question is going to be how we're going to distribute it. This is where crypto plays in several layers. We've seen central bank digital currency proposals to have direct crypto distribution to the masses. Whether crypto is the right way to do it or not is almost irrelevant. It's wallet digital technology that's relevant here, and crypto is advanced in that respect. So some crypto solutions may yet fit the bill. But more importantly is the protection of the assets that people are looking at. And in these turbulent times, the assets fluctuate wildly. And it may be the case that, in fact, we see asset deflation across the board. If, in fact, the amount of money in circulation, because the work evaporates, and we sure hope it does, because there's a lot of unnecessary work. This is all financial flows at the end of the day. Asset protection is possibly the most important thing. And the problem with real-world assets is that their price will go down following the Japan deflationary asset, or go up following the '08 playbook in the United States. Crypto can play a very key role in terms of asset diversification and protection, because the price action of the crypto assets is by and large uncorrelated from any underlying economic assets, because very frankly, there are none. There are no endogenous cash flows attached to pretty much any crypto. And so from that standpoint, cryptos actually represent a fairly attractive asset class, because their price action isn't correlated from the underlying real economy. And as a matter of fact, at least on the perception layer, crypto may be seen as a hedge by a lot of proponents, as a hedge against further monetary expansion. Mm-hmm. So crypto should definitely be as part of the portfolio of the smart investor in these chaotic times.
Marc, and you mentioned that the distribution of wealth, of that abundance, is uneven, but that is exactly the case with crypto just as well, because though regarded by many as an alternative monetary system, alternative money, it is actually highly concentrated on the one hand. On the other hand, it is completely unsuitable to be that money. So what is your take on this, and how crypto should be regarded as an asset?
It is true that contrary to our rhetoric or the narrative we tell ourselves and the others, crypto is actually a fairly centralized play. And you made reference to the wealth concentration, which we measure with the Gini coefficient. And the Gini coefficient of most crypto assets, including BTC and Ethereum, is some of the most highly unequal and concentrated wealth in the history of financial instruments, period. That being said, it remains true that the wealth has flowed to people that do live outside of the traditional financial systems. And that is also a new phenomenon, that you could have phenomenal wealth formation outside of the traditional financial realm, directly in the crypto layers, because there is a conflagration of the store of value function and the money aspect in terms of store of value and exchange with the crypto. So the role that crypto plays in the distribution is, very frankly, a little bit unclear to me as a practitioner of crypto. And let me walk you through why in a short 30 seconds. On the positive side, crypto is fairly advanced in terms of wallet technology, even though holding crypto keys to the wallets and losing your crypto keys is not very user-friendly, as in it's a catastrophe for most people. Grandma can't deal with crypto keys. It's 3 steps back for grandma to understand that. she needs to not lose her crypto keys or her assets are gone. That really, frankly, makes no sense at the retail layer. And so when we talk about distribution, technically speaking, it may be the case that direct deposit, as we have seen from the Fed directly to the bank charter members, to deposits, or direct credit cards distribution, or debit card distribution, or even, you could imagine a PayPal distribution, a Venmo distribution. The Fed could take an open source solution that is out there and just standardize on it, forget who created it. It's irrelevant. In fact, they should not be there. And so I think traditional fintech is more suited to solve the technical aspect of distribution than crypto is, because let's face it, crypto is probably infrastructure technology and really, really not well suited for the masses when we deal about, hey, what's your crypto key to go pay the groceries? That's just a layer of technical complications that we don't need and very frankly does not make any sense, period. The philosophical aspect of it is, however, very, very different. And this is where crypto philosophically does say something, even though technically it is ill-suited. Karl Marx, the great sci-fi writer of the 19th century, proposed as an hypothesis that the logical conclusion of automation, and in fact capitalism and the Industrial Revolution, would be that machines do the work. And that worldwide, forget your little nation and your local production, you have supply chains all over the world with machines making food and gadgets and iPhones and all that. And he called it third stage abundance. Ironically, we arrived at abundance not through the tools, the political tools of communism, which were actually catastrophic on the economical front, because they mostly ignored the personal motivation of the people who create the wealth. We arrived at it through the tools of capitalism and the financial representation of equity, which, as its name indicates, was an equitable, a fair distribution for those who created the wealth. So if you were a techie in Silicon Valley, you got equity, and that's how you got rich in the 20th century. So this creation of abundance, this creation of wealth, has come with a distribution of said wealth through equity and debt, namely capitalistic tools for the distribution. We arrive now at possibly a silent revolution where we have abundance, but the question is who gets to eat? Who gets to eat? The fries are not being eaten at McDonald's, so the Netherlands farmers are storing billions of potatoes. Think about it for a second. It's the inverse of how America got made. America got made on the back partially of the potato famine of Ireland, where a lot of Irish people came to the United States because we didn't have enough potatoes. We have the opposite situation. The problem is they're going to rot in warehouses because we don't have a way of accounting who's going to get the fucking fries. Pardon my French, the French fries. So that's the bit that doesn't really make any sense. And that's the bit that is going to need to change. And just to go a bit on a tangent to not talk crypto or philosophy, but now talk psychology of the masses through this chaotic arena, is that people, as a matter of fact, want to protect the existing work. They want to go back to work. Wake up. You're not going back to work. And in fact, enjoy this quarantine and your lifestyle right now, because this is how rich people live. Let me tell you, I've been living for 10 years in isolation. It's good. It's fine if you don't get too bored. Okay, so you have a lot of people. Actually, it's not the elite that is oppressing, I think, the people here, even though there's a lot of conspiracy theory. What I'm saying that worries me is actually the populist reaction to, I need to go back to work to eat. No, you need to sit the fuck down. In fact, forget COVID. It's irrelevant. This is about post-capitalism and distribution of goods. Crypto has opened the door. Crypto has shown the way philosophically, technically, and psychologically to some extent. I think what's going on is much bigger than crypto and accelerating all of that.
And I also have a question about the different kinds of crypto. So as we know, the boom of ICOs that we saw and its killer applications such as like capital formation. And then there is SCOs. that people were largely talking about last year that was supposed to become this next wave of ICOs that, however, won't misallocate the capital, but become the next big step. And apparently this is not happening. So in your opinion, what is needed to make crypto great again? I understand that it's not only about crypto, but how do we actually bridge the traditional finance and the new blockchain-based currencies? So what do we need here to actually make it work?
Okay, there's two parts to this question, and I'm going to try and tackle in order. The first order of business is, in fact, what types of crypto are out there? If you think about it, there's really two types of crypto out there. The stable coins that have their value pegged to a fiat currency, USDT, etc. And there's moon coins, Lambo coins, and sort of Volvo coins. The moon coins have no underlying assets, and they're mostly used for speculation to have 10x returns in crypto exchanges, etc. So I think the starting point, even to address the second part of the question, which is about STOs and other fundraising mechanisms, or even the token that 2Prime is marketing with FF1, is that we know two successful aspects, stable coins and moon coins, and FF1, for example, is a hybrid coin where we have aspects of the stable coin, meaning we can't go under, there's a floor, there's an endogenous floor, or a put, to speak financial options, but there's also upside. Now, it's not 10x upside, but 2x, 3x upside is still baked in. And that's a new type of coin. We haven't seen that type of coin in the markets, even the traditional crypto markets. Let's go to STO. I was a big proponent of STO. I've spent quite a bit of time, invested there, worked there, and was very excited about STO at first. The problem, well, let's not say the problem. The idea that we would trade these traditional financial assets via crypto exchanges, I think where we went wrong. In fact, there is not a match between the expectation of a trader that is trading crypto and the financial profile and retail that an STO offers. And vice versa, a crypto STO is probably too complicated and too alien to your traditional securities dealer and securities trader that is used to actually fairly liquid and large markets. If you take, for example, the real estate trust, the REITs in the United States, which is a way to get exposure to real estate, which supposedly the crypto is going to do, those are very large markets. They're very liquid markets. They work very well, meaning crypto is not really saying anything, neither technically, legal. Well, there's some aspects to legality. There's some interesting STOs this year with real estate to optimize certain tax aspects, but they're very small. It's not a big innovation. And the key to innovation is that if you're going to succeed, you need to really transform what's going on. And I don't think STOs today are doing any of that, mostly because the people who go to the exchanges, specifically the Asian traders, have a very different mentality. They come here to gamble and invest, and this whole security token is a very Western thing. I just don't think it's a fit right now. I'm not saying it won't be the case in 10 years. It's probably true that everything will be digital in 10 years, so STOs will be the dominant thing, probably under another name. But right now, I don't think it matches how what people do in the exchanges today, which is why STOs have failed to take over. There is no liquidity. There's no one buying. And actually, there's not many people selling, except the people doing the digitalization and the tokenization. It's all service-driven right now.
And generally speaking, do you believe that fully blockchain-based digital infrastructure for financial markets is possible in the future, in theory?
If the question is about blockchain, we have to really separate what works in blockchain and crypto from what doesn't. What works in crypto are the coins that are stable or moon in the exchanges. All of this is exchange-led. Okay, who's making money today in crypto? The miners and the exchanges with the traders. That's it. And traditionally, it's been that. So blockchain, the technology, is just a very fancy database that is not owned by anybody. So we can have a parallel unit of account and store of value that cannot be shut down by governments. And therefore, the first application of it, let's not lose sight of the fact or even denigrate it, of the fact or denigrate the fact that we were born in illegality as a field. The fact that no government can shut you down, no nation state can shut you down, is a huge thing at the level of the planet. The end of nation states from a complete overreach into your stores of value. That's important. However, that feature is not sufficient to really impact the future of crypto as a financial market construct. What I find interesting is mostly the exchange behavior, the technical aspects of the velocity of money, the capital formation in crypto, the price dynamics, the order books dynamics in the crypto markets, as opposed to the more traditional markets based in fiat who have a lot more friction. You know, the crypto markets are global. The crypto markets open global liquidity. They are not subject to local rules, even though when you get to the fiat, you are subject to local rules. But witness even what's going on with security tokens. To some extent, the whole STO phenomenon was based as a US-led reaction to lack of clarity around whether those crypto assets are securities or not. And there is no other reason for it to exist than who's legislating these exchanges. This has nothing to do with blockchain. And so to answer your question in 5 seconds, no, blockchain probably does not have much to say technically to the functioning of these markets. It's the markets themselves that are interesting. The aspect of blockchain that is important here is that we can transfer globally across legislation and jurisdictions global stores of value that are internet denizens, and that does completely change what these exchanges can do, namely transnational fund formation. It's the future of capital formation. It's the future of crowdfunding, global crowdfunding, where you don't have to crowdfund to the dollar, et cetera, et cetera. Bear in mind, and this, I'm sorry, I'm just going to take a quick tangent for 20 seconds. Bear in mind that most commodities in the world are today settled in dollars. Okay, not just oil, like basic food staples worldwide are settled in dollars. Okay, and that obviously confers a lot of power to the U.S., to the Fed, and witness the fact that we're creating trillions of dollars, and still today, in the middle of COVID, and by today I mean today, there is a dollar shortage. Why? Because all of our commerce is based on this accounting based on a numerare that is the dollar, which General de Gaulle, the French president after World War II, called the United States exorbitant privilege, which it earned by winning World War II, really, establishing the worldwide de facto currency reserve. To me, it stands to reason that a version of a blockchain will one day provide this backbone. Maybe USDT, who knows, right? But so that the monetary issuance would be on this blockchain. We'll see. And I don't want to go too deep that rabbit hole, but that stands to reason that these global markets, our global needs in exchanges, our global supply chain do in fact need something that is global in terms of its accounting measure.
Wow. Okay. Marc, I want to get back to another point of yours, which you mentioned when speaking about the FF1 token, which represents a hybrid token that has features of a stable coin and then has a features of a token that can grow in price. And by the way, the token has actually showed itself pretty well in the current market situation when it didn't dump. It remained stable. It proved itself a store of value. But you mentioned that we haven't seen such a coin on the market before, and why we haven't seen anything like that, and why you're introducing it now, this token and the continuous token offering model.
The FF1 hybrid profile is one aspect. The continuous token offering is another, and I'll answer your questions in that order. Indeed, there's two coins that work: stable coins and moon coins, BTC, ETH, and then USDT on the stable coin front. A hybrid is, in fact, a little bit of a difficult category to conceptualize, because if it's a stable coin, you're not expecting price move. In fact, there's been some commentary of late that stable coins may be dying because their whole business model was based on the rate of free money for their assets under treasury, meaning if you manage $1 trillion worth of USDT, then you're able to maybe make 2% as an interest on your cash. But now that cash is actually negative value, meaning you have to pay to hold the cash. We have negative interest rates now. This business model may evaporate very quickly. On the other hand, when you have no assets at all, then the paradox is that zero equals infinity, meaning zero cash flow means infinity valuation, so you can have whatever you want. What we're trying to introduce is the mix between the two. I call it the Lambo and the Volvo, and the Lambo or the Volvo or whatever you want to call it. But this hybrid profile where you have essentially an endogenous floor when you can go and dump, but you also have a growth of the token. And it's not been done before because you're either one or the other. And people go for the 10x or they go for the fully stable. And in fact, there's some magic to get it working in the middle. What rates can we sustain, etc. We were lucky at 2Prime and unlucky at the same time to launch the token FF1, the first hybrid token of its kind, or one of the first in the markets on March 15th, the day BTC took its biggest dump ever, minus 50% intraday. And we went out like it was Stalingrad. It was beautiful. We just actually survived, not only survived, but gained that day. So as a net result, we were top of the exchange where we were for that day because we gained 20% when everybody else lost 50%. So we looked very good. But besides that one day, it's been extremely choppy markets in the exchanges, as you know. A lot of volatility across the board. And FF1 has not only kept, but slowly exponentially increasing. And, whether you grow 3% a week or you grow 10x during the week, in the end, it's the same thing. And this is where, we decided, for example, with the FF1, to do the CTO, the continuous token offering, as opposed to the IEO, because most of the Chinese exchanges are set up to do IEO and engineer a pump and dump intra-week. Okay, so it's basically, I won't name names, but I had this conversation with one prominent exchange, and they basically yelled at us, going like, no, you have to do pump and dump. That is the only thing that works. And, we're saying we don't want a pump and dump. We want to avoid a pump and dump because we think that's not good for the users, the retail users. It's good for a few whales that can speculate privately, etc. But if you're going to be taken seriously, avoid the pump and dump. And this particular exchange was banging on us saying you have to do it. And everything in their supply chain, both Telegram management and WeChat management and just the marketing in general is just geared towards pump and dump. And so we decided it's not a fit for us. Not that it's good or bad. We don't want to judge pump and dump because at the end of the day, it has given us a vibrant crypto industry, even if ephemeral and with little application to the real world. Here with the CTO, we're saying, look, we're just going to release the tokens when there's real demand. So we're not pumping and we're not dumping. In fact, every token in circulation is a token that's backed by some value that's going to accrete. So it's fractionally backed. And the CTO just makes sure that we can continuously offer the token as the price grows. Now, here's the little magic trick, okay, of exponential growth that most people forget. Let's say that instead of 10x during the week, we target 3% during the week, which is very boring to most people. Well, if you put into your calculator 1.03 to the power 52, You can do it now, but I'll give you the number. It's 4 point something. Okay, show me in this environment a asset that is going to tell you I'm targeting a 4x return for the year. Right? Even Bitcoin, that would mean Bitcoin at 24,000. Okay, which is possible. Actually, 28,000 with today's price is possible. I'm not saying it's impossible. We see 30,000 this year, given the all chaos that's going on. But those are big numbers. So you have to really pay attention to sort of the magic of discrete, invisible, exponential growth. And these are targets we put in our market makers, meaning our bots that are doing the market. Today, the price, I think, is 3.24. We went out at 3. So in a month, we gained 8%. Right. So and it's a very, very smooth thing. I mean, in the beginning, we had some choppy, but we're really smoothing out the curve. So that's a new brand of token. That's a new brand of crypto asset. Its difficulty and its opportunity is that it's a hybrid. So, for example, people tell me, well, I can't invest in this because we don't invest in funds, typically crypto funds. Okay. And because you invest in other assets, you have a fund of fund aspect. Yes, we do. Other people tell me, well, I don't invest in stablecoin. Yeah, but we're not even a stablecoin. Some people say, why don't we do this stablecoin as the pair, trading pair in exchange as opposed to USDT, so that you have a deposit that grows over time, just like staking does, right? So its difficulty is its opportunity. Chaos changes psychology, perception, and mentality. There's a causality chain of effects that we're seeing unfold. We're walking that path. So far, the path has been good to us. We've been very solid, proving resilience in the worst of markets, and proving we can go up very smoothly with a smooth exponential, discrete, slow growth that compounds over time to quite a bit.
I probably will ask one last question. I think we have the time for one last question.
Yeah, we're almost out of time, but yeah, I think we can do one more.
Marc, I will ask you to tell us a bit more about what's backing this asset. So you say that the asset is fractionally backed. FF1 token is fractionally backed. So what mechanism actually lies behind it? If you can give us a hint of how it looks, because probably that's something that is not easy to grasp as well for many when you are talking about this.
So in this extremely volatile market, it's fairly easy to just fly over a few currencies in terms of assets management. So right now, the treasury of 2 Prime is sitting in FF1, USDT, and BTC. We will be adding other currencies, liquid cryptocurrencies, say Dash, say Bitcoin Cash, say Ethereum, etc., the top leading brands. But right now, the volatility is such that, as a matter of fact, I shouldn't say it too loud, but we're super backed this morning, meaning the value of assets is above what it's trading at. And we like it that way because it gives us a nice smooth ramp. So in terms of asset management, right now it's BTC. We're moving the BTC to BlockFi to have a 6% return. And we will allocate to partners in private equity down the road, but we haven't yet just because we're getting started. So today, the way the assets are managed is BTC trading and BTC BlockFi. And that, as of the first month of trading, has given us a super backed coin, including our costs. So that's the good news to everybody who's bought FF1 to begin with. They're up quite a bit. In real terms, fully backed. Actually super backed. So again, leading crypto today, BTC, leading lending, BlockFi 6% to 8%, depending on who you talk to and the currency. And in the future, we have established partnerships with the likes of prominent VCs and private equity funds that usually retail investors do not have access to. So from a retail investor standpoint, it's sort of a better way to hodl because you have active trading and investment in other vehicles. And you also have access to funds you normally wouldn't have. And in terms of a fiat private investor, it's exposure to the crypto field in a way that doesn't suck and is diversified from the get-go. It's also fully legal with an SPV in the United States, et cetera, et cetera.
Okay. Yeah, Mark, thank you so much for your answers. I wish we had more time. But thank you so much. We'll be sharing more information about Prime in the comments or just on our channel as well. And thank you so much.
Thank you so much.
Thank you. We should probably do another one.
Okay, whenever you want. Thank you.